Afternoon, everybody. Great to see so many people logged on today for our webinar on regulating cryptocurrencies to mitigate risks for their misuse for terrorist financing. We have three panelists today who are going to present their insights from their research and from policy development work on this topic. And so we're very much looking forward to having them with us today. I'll introduce them as they present. My name is Jennifer Hanley-Giersch. I'm a managing partner at Berlin Risk and a board member of the ACAMS Germany chapter. Just briefly, Berlin Risk is a risk and compliance advisory firm founded in Berlin in Germany 12 years ago, serving private and public sector clients globally. Our partners have between 15 and 25 years experience, and we're all certified anti-money laundering, fraud and sanctions specialists working on advisory assignments and investigations globally. So our main aim is to support organizations in minimizing legal and financial risks while protecting reputation. As you can see, there's another logo up here, BCF Partners. This is a consortium of European risk advisory firms, which was co-founded by Berlin Risk in 2015 to serve European multilateral development banks on risk and compliance topics. Now, let me move on to the background for this webinar today, which was a study published by Counter-Extremism Project and Berlin Risk earlier this year. The study is based on a wide range of interviews and discussions with anti-financial crime experts, as well as focus groups sessions like those held in cooperation with the German Institute for International Security Studies. The study on regulating cryptocurrencies was launched in Germany in partnership with the ACAMS Germany chapter and with the New York office of the Konrad Adenauer Stiftung. Now, although some progress has been made in terms of bringing virtual currency exchange platforms and custodian wallet providers under scope of the fourth and, of course, the fifth EU Anti Money Laundering Directive, the discussion has really moved on in the last couple of months. On the 7th of May 2020, the European Commission adopted the action plan for a comprehensive union policy on preventing money laundering and terrorist financing, which they launched earlier this year. Now, to gather the views of citizens and stakeholders on these measures, the Commission launched a public consultation in parallel to the adoption of the action plan. Details of the action plan can be found on the EU's website. Now, as part of this consultation process, the Counter-Extremism Project in Berlin Risk submitted a policy paper, which can also be downloaded on CEP's website, but also on the EU website. You can see a summary of what was submitted, and we will hear the results of that presented by Hans this afternoon also. Now, the consultation process remains open until the 29th of July and is open to anybody who wants to join. Now, the EU's action plan itself includes regulatory measures relevant to cryptocurrencies, which is what we're going to talk about today. But in addition, and I think this is also important, to this consultation process, we also have a consultation process for the revised EU risk factor guidelines for the fifth EU AMLD, which is also ongoing and includes recommendations to be made to regulate crypto exchanges. So both European legislators and industry bodies are hoping for more harmonization, which might lead to the introduction of a regulation as opposed to a directive. And this could also be in the interest of effectively regulating cryptocurrencies. And now I'm going to introduce our first speaker for today, Kayla Izenman. She's a research analyst at RUSI's Center for Financial Crime and Security Studies based in London. Her primary research projects involve North Korean sanctions evasions through cryptocurrency and looking into money laundering via online businesses. In September 2019, she co-authored the paper From Intention to Action, Next Steps in Preventing Criminal Abuse of Cryptocurrencies. And prior to joining RUSI, Kayla interned at the US Department of State, US Department of Commerce, and the Foundation for Defense of Democracy's Center on Economic and Financial Power. And I would say, Kayla, the screen is yours. Looking forward to your thoughts.
Hi, yeah. Hans, did you want to say something quickly? Sorry.
Yes, sorry. Sorry for the hiccup. The idea, whoops. I would like just to say a couple of words about CEP and our cooperation with Berlin Risk. Let me get my camera sorted out. Yeah, finally. Before we start, this is a cooperation seminar. I'm Hans Schindler, the Senior Director of CEP, and of course, also from my side, thank you so much for taking part in today's seminar. And I want to give a couple of technical remarks at the end of my introduction of CEP as well. CEP, as many of you know, and some may not yet know, is a transatlantic organization that was founded in 2014 that works both in North America and Europe, and we're very glad to partner with Berlin Risk. CEP has offices in New York and Washington, DC, and representation or the representatives in Paris and Brussels, so covering also the EU level. And since October 2019, we now have a permanent office and a separate legal entity, CEP Germany, DGmbH, so a charitable organization here in Berlin. And this is an event of the Berlin office of CEP. CEP, as you may see from our website, works against all forms of extremism, all the way from right-wing extremist and terrorist groups to all the way to the Islamist terrorist spectrum. We do this in 3 work streams, pure CT issues, and this webinar today falls within this category. Here in Berlin, we have developed together with Berlin Risk a specific expertise and work stream on cryptocurrencies and terrorism financing. The second work stream is cyber issues more broadly. How do terrorists act? What do they do? How do they finance? And how do they propagate via the internet? On the one hand, analysis. On the other hand, the development of effective advice for effective and efficient regulations. So we're very much involved in the discussion concerning the terrorist content online regulation of the European Union, as well as the now beginning Digital Services Act discussion. If you're interested in these topics, on the 22nd of June, during lunchtime, Berlin time, we will have a webinar discussing the new Digital Service Initiative, the Digital Services Act, which is the update to the e-commerce directive, with an expert as well as from our perspective, because there is now a public consultation going on, and this is a very important EU initiative. And then on the 29th of June, together with the Konrad Adenauer Foundation, we present our latest report on deepfakes and political manipulation. The third and last work stream for CEP, but also here in Berlin, is CVE, PVE issues, anything countering violent extremism. And here in the Berlin office, we have a specific emphasis on rehabilitation programs for released terrorist offenders, which of course is, given the large-scale arrests in Europe during the last few years for foreign terrorist fighters that traveled or came back from Syria and Iraq, a growing work area. We had a couple of weeks ago a seminar together with the Radicalization Awareness Network, as well as our partner in the US, Parallel Networks, on this very same topic. You can find the videos on the CEP Germany's YouTube channel. After this brief introduction, let me just give you a couple of technical remarks. As always, in a Zoom webinar format, unfortunately, your videos and microphones have been disabled, but that doesn't mean we want you to stay silent. If you go with your cursor to the bottom of your screen, you find a window that's called Q&A in the English version of Zoom, or F&A if you use a German version. If you click on this, you can type questions in at any point during any of the presentations or this webinar. You can choose either to type those questions in under your name, or you can also choose to type in anonymously. We will then, or our moderator, Jennifer, will post those questions, summarize them if there are many, to the presenters. We would ask you to please, this makes lives easier for everyone, especially for Jennifer. If you have a specific question to a specific presenter, please mention that in your question. Or if you all presenters or two of the presenters, so that Jennifer knows how to whom to pose this question. Last thing I wanted to mention on the technical side is that we will record the presentations, i.e. Kayla's, Gabriel's, and my presentation later on. We will, however, not record the Q&A sessions. We will, after each presentation, have 5 minutes for just basic questions of understanding in case there was an audio problem or you have a specific question to one detail in the presentation. And then we will keep the broader questions for the about 30 to 40 minutes that we will have after the last presentation, after my presentation, for the general discussion. So I hope, please be actively engaged. I see someone already has found out how the Q&A works. Please, I encourage you to do this throughout the webinar, and I'm very much looking forward to the discussion and would like to hand over back to our presenter, Kayla then.
Hello, sorry for that brief, I don't know, miscommunication there. Hi everyone, I'm Kayla. You heard a little bit of my background earlier. I'll just briefly sort of reintroduce myself, but let me share my PowerPoint. Okay, so hi, my name is Kayla. I'm a research analyst at RUSI's Center for Financial Crime and Security Studies here in London. I've been looking at crypto and financial crime in general for about 4 years or so now. So that ranges from crypto and terrorist financing, crypto and money laundering. One of my really huge projects, as Jennifer mentioned earlier, is crypto and sanctions evasion, primarily looking at North Korea. So I've sort of, we've looked at scams, all sorts of things, and we've looked at other types of online businesses, online gaming, online gambling, and how those might intersect and some of the similarities. So I think I have a pretty good understanding of what the landscape really looks like. And that's really helped me identify similar typologies that you end up seeing with all different types of financial crime risk using crypto. The ones that you see across terrorist financing and sanctions evasion and just money laundering generally. So just to introduce a little bit about RUSI in case anyone doesn't know who we are. We're the Royal United Services Institute, founded in 1831. We have offices around the world, and the Center for Financial Crime and Security Studies, which is what I'm in specifically, was founded in 2014. We do all sorts of stuff regarding countering financial crime. So it ranges from what I was talking about, which is part of our Financial Crime 2.0 project, looking at emerging technologies and crypto, to all sorts of things. We look at international wildlife trade, human trafficking, organized crime, sanctions, all sorts of stuff. So hopefully if you do check us out, we do more than crypto, the same way that CEP has a whole range of programs. So this is what I'm basically going to talk about. I'm going to start off with some types of crypto-related cybercrime. I'm going to move on to a little bit of specifics on crypto and money laundering, then go into privacy coins and mixers, and finally just touch very briefly on peer-to-peer exchanges. I've tried to structure this presentation so that it really illustrates why regulation is necessary and why regulation of specific pieces is necessary. I think it should hopefully provide a good background for all of you, so that the discussion of what FATF and EU regulation is like right now makes sense, and you understand why there are discussions over certain things that should or shouldn't be, such as crypto to crypto exchanges, why there are debates over things like peer-to-peer exchanges, so that it becomes less of in the weeds discussion of regulation and more of a full understanding of what the landscape looks like and the best way to approach that. So I'll really be focusing on risk because I know that the other presenters will really be focusing on regulation, and that will provide, I think, a really good overview of everything altogether throughout this webinar. So to start off with, cryptocurrency features really heavily in a lot of different types of cybercrime. Most notably that you'll probably have heard of would be ransomware hacking and then the dark web in general. A lot of this is due to poor security practices among the cryptocurrency industry itself, but you also do have to understand that there are poor security practices with individual users of crypto. A lot of people don't understand what the risks look like, and they don't understand how they can secure themselves. People are generally much more aware of how to be security conscious when they're looking at fiat currency or their own bank accounts or even cash than they are with crypto. They might use an exchange and they don't know the KYC that's with that exchange, so they don't know if it's reputable, they don't know how their money is being held. Is it being held online? Is it being held offline? Has that exchange been hacked before? Obviously, the responsibility is not necessarily on individual users, but it is interesting that they're generally less aware of who they're transacting with. So to illustrate this, losses from fraud, misappropriation of funds, exchange hacks, and thefts added up to $4.5 billion in 2019 alone. This is just a timeline of 2019 cryptocurrency exchange hacks that I took from Cointelegraph, which is a really good resource for keeping up to date on crypto news. And so I'm not going to go through everything. I just find it really indicative of the sort of poor security practices that I'm talking about, and also to some extent, the lack of regulation in a lot of these places. I'll touch on it a little bit because I'll talk about North Korea, but there are exchange hacks currently all the time, and there are more that likely haven't been reported, and most of the funds from these hacks have never been recovered. So it's just one of these things. There are exchanges that have been hacked 3 times and people are still putting their money in. So there's an individual responsibility, there's a responsibility on the exchange to up their security to really the level of banks because they are holding people's funds. And also a responsibility on local regulators as well as international regulators to really be able to plug those gaps and sort of force best practice, I guess, onto the industry as a whole. So these are the general types of illicit activity that you see people engaging with in crypto. And I also want to make sure that I mention crypto is not only used by illicit actors. I would hope that everyone knows this. I don't at all mean to imply that these are the only people that are engaging in activity using cryptocurrency. And I don't even mean to imply that they're the majority of it. It just really does speak to why regulation is necessary, because these people are definitely using it. You could, I don't really have time, but you could find case studies for all of the activities listed here plus more. So this is just terrorist financing, money laundering, sanctions evasion, dark web, and scams. I'm going to focus on money laundering because, as I'm sure you all understand, it really enables all other forms that we're talking about here and that we're focusing on in the regulation. Being able to move money from criminal activities through the system doesn't really change no matter what the money is coming from or who's using it. So if terrorists crowdfund using crypto, they then have to cash out at some point. They need to move it somewhere to get it back into fiat currency, or they need to be able to spend it in cryptocurrency on the other end. If North Korea is evading sanctions using cryptocurrency, they also need to be able to spend that at some point if they need to be able to hack an exchange to get it. If dark web users are trying to move it out, they also need to be able to pay, and they have intermediaries for a lot of these things, same with scams. So a lot of the typologies are actually really similar, no matter which type of crime you're looking at. This is an example that I pulled from Chainalysis. They published a really good report on this called The State of Crypto Crime 2020. I really recommend reading it if this is something you're interested in. And this is just an example of money laundering through over-the-counter brokers. So I don't want to get too in the weeds on sort of tech terms and what all of this necessarily means, but all that you really need to understand is you have illicit funds on the left. They went to an over-the-counter intermediary wallet, which is basically just a personal wallet that they were sent to after they were either hacked or, terrorists sent them, whatever the case study is. They then go to what they label as the Rogue 100 over-the-counter brokers. Their list of Rogue 100 are essentially known actors that are involved in money laundering schemes. So I can't tell you their identities, but the note is that they are known money launderers. So it gets split between 2 of them, and then between the 2 of them, they mix it and send it to an exchange on the other end that is then able to exchange. You can use that exchange to exchange it for cash. And it's sort of gone enough hops that you're separating it from the illicit funds at the beginning. Similarly, this is a case study that I've looked into with pretty great detail, and this is a North Korea hack. So this is money laundering via an unregulated exchange. So North Korea hacked, as a state actor, hacked the South Korean exchange called BitThumb. They then moved it to their personal North Korean wallets and moved it from there to Yobit, which it was, it's now more regulated. But at the time, it was an unregulated Russian exchange that also offered transfers into web money and various other types of crypto. And because it was unregulated, the money just could move straight through that and you wouldn't find it on the other end. So hopefully, sorry, before I get into privacy coins and mixers, hopefully I hope that wasn't too sort of in the weeds, but I'm just trying to sort of illustrate where regulation in both of these cases could be hit. So you have exchanges operating in both of these cases, sometimes multiple, and you also have places where the person moving the funds should have been identified by that exchange. They should have been caught. In some cases, if the exchange is being hacked in the first place, so you look at BitThumb, they shouldn't have been able to be hacked, especially because BitThumb was one of the exchanges that got hacked multiple times. And so you really see, I find that these graphs are really indicative of, where regulation can play a role and where it's needed and where you would see an active, tangible difference in the amount of illicit funds that are moving through the system. I just also wanted to touch on privacy coins because I know that there's something that people usually have questions about and they come up a lot. So one of the big ways that law enforcement and exchanges themselves are able to understand what the flows of cryptocurrency looks like, for instance, the Chainalysis report that I talked about, is using tools like Chainalysis. There's a lot of them: Chainalysis, Elliptic, CipherTrace, there's all types. Some exchanges have their own, like Coinbase has Coinbase Analytics. And that is called blockchain tracing or blockchain analytics. And it means that a private sector company basically goes in and applies large scale data analytics activity to a transparent blockchain, which is what Bitcoin, for example, is. That's what Ethereum is. You can track exactly which account sent money where, how much money they sent, the date they sent it, all of the transaction activity related to the addresses from the sender and the receiver, all of that. However, which is great because then you end up seeing these typologies and understanding where regulation can step in and where cybersecurity practices can step in. Alternatively, you also have privacy coins and mixers, which their goal is to obfuscate those blockchain tracing techniques. So the largest three are Monero, Zcash, and Dash. Of the three, I'm not going to talk about the specific privacy models that they have here. It's quite in depth, but I pulled this from our paper that Jennifer mentioned earlier. And so if you do want to read more about it, we go through it there. And that link will be, I think, sent to you, or it can be put in the chat. But essentially, Monero is the most private because it is private by default. And what these coins do, specifically Monero, the other ones are on and off, but Monero specifically is really, it blocks, sender information, it blocks receiver information, it blocks when you're sending the amount of money, it blocks how much money you're sending, all of the things that allow blockchain analytics to sort of track down bad actors are unavailable. Now, it's understandable why these exist. People really do have the argument that there's no reason someone should be looking at all of their fund movements, that crypto wasn't created to be a completely transparent system like it is with blockchain. Some of those are I think they're completely fair arguments, but this is certainly bad for, say, law enforcement trying to understand where the bad actors are, and even for exchanges trying to use KYC and CDD practices, they're not really knowing who their clients are transacting with because you can't see. Even if you know who the sender is because it's on your exchange, you don't know who the receiver is, and so on. So these are really becoming a problem. I will say that Zcash and Dash can sometimes be tracked. And there are also issues with using privacy coins at scale. They're not necessarily the biggest sort of risk right now. Probably regulation in terms like creating best practice regulation for Bitcoin and other sort of transparent blockchains hasn't necessarily even been hit. And that piece is what really needs to be addressed before we worry about privacy coins. There's difficulties with cashing out of them. There's difficulties with, you would have to go crypto to crypto instead of crypto to fiat. I can get into it if anyone has questions later, but it's just something to sort of keep an eye out on and be aware that this is something that is certainly a more emerging form of cryptocurrency. And then finally, I won't really spend much time on this, but there are also peer-to-peer exchanges. So all the exchanges that I've spoken about so far have been centralized exchanges, which is what the majority of the cryptocurrency industry uses right now. When you talk about something like Coinbase or Binance, those are centralized exchanges, and there's a team at the back that is operating them and holding funds. Peer-to-peer exchanges are exchanges that do not assume control or custody over the user's cryptocurrency. So the operators of a peer-to-peer exchange might not have full insight into the activities of its users, which obviously is very concerning if you're someone like us who's worried about how regulation might play into that and how much information you're asking from the users of an exchange. There are different types of it. That's what this little chart is. Again, I don't really have time to go into it, but it is all in our paper if you're interested in more. And so they're certainly of concern, and there's a lot of debate in the regulation space as to what type of peer-to-peer exchange can you regulate, because who are you regulating if there's nobody holding custody of funds? So that's sort of an ongoing discussion, and I'll be interested to see if it's brought up by the other panelists in terms of their discussions of what regulation will look like moving forward and what it looks like now. And then the final thing is, I just wanted to close off with plugging this survey that we're doing right now. So we just on Monday launched the RUSI ACAMS Cryptocurrency Risk and Compliance Survey. It is a survey that I sort of am leading on and help put together. We're really trying to create a quantitative database to understand where the risks in terms of financial crime and the problems in terms of regulation and compliance are from all perspectives. So we're inviting people in financial institutions, in cryptocurrency industry and fintech, in governments, in law enforcement to take part. If that applies to you and you would be happy to fill out a 15-minute survey, it's completely anonymous. We're working with YouGov to make sure that the data is strong. Just email me at kaylai@rusi.org and your affiliation. I just need to make sure that you're in one of those industries or related, law, academia, so that all of our data is sort of relevant parties. That's the only reason we need your affiliation. But yeah, if you're interested, just email me and I will send you the survey link. We're trying to get as many responses as we can so we can really show accurate representations of views from all regions and all sectors. So yeah, just wanted to mention that because I figured you guys would be interested. That's it from me.
It was a very interesting presentation, Kayla, and I think everybody will be wanting to read that report to understand a little bit more what's happening in the weeds. And I think there's a lot probably to learn. Now I would like to welcome Gabriel Hugonnot, who is our second speaker today. There you are. Hello, Gabrielle, welcome. So Gabrielle, briefly, I'll introduce you. Gabrielle is a French civil servant from the French Ministry of Economy and Finance. Since 2018, he's been seconded to the European Commission, to the Directorate General for Financial Stability, Financial Services and Capital Markets Union, which is in charge of money laundering and counter-terrorist financing policies. Gabrielle's background is in law, international relations, and economics. Before joining the European Commission, he worked as deputy head in the Unit for Economic and Financial Affairs of the French General Secretariat for European Affairs in Paris between 2013-2015, and then as a financial attaché at the French Permanent Representation to the EU in Brussels between 2015 and 2018, where among other files he negotiated the 5th review of the Anti Money Laundering Directive for France. Now, Gabrielle, the screen is yours. You have your presentation.
Yeah, thank you, Jennifer. I believe you can maybe put the slide instead of me. Yeah, perfect. So maybe we can start by going first to the first slide. I mean, not this one, but the following one. So my intent today is to present you first the state of play of our regulatory framework for dealing with virtual currencies in the actual AMLD5. Then I will present you briefly the content of the work achieved during the last 2 years in the FATF, and eventually I will present you where we stand at the level of the European Commission, the possible next steps and the content of additional measures we could take. So to start first with where we are now in our EU framework, the AMLD5 introduced for the first time a definition of a virtual currency, which is a digital representation of value that is neither issued by a central bank or public authority, which is already excluding all the central bank digital currencies, nor necessarily attached to a fiat currency, but which is accepted by natural or legal person as a mean of payment and can be transferred, stored, or traded electronically. It is clearly stated in the recitals that it is not an electronic money, and it is not either a fund in the meaning of payment service of the Payment Service Directive. So we have this definition, which is already a good first step. But at the moment it was introduced, there was a clear willingness not to create too much confusion with other financial regulation of the EU. Can we move to the next slide, please? In the same text, we introduce also two new obliged entities dealing with virtual assets that are exchange platforms between fiat and virtual currencies, and the wallet providers, the custodian wallet providers. And these two actors are submitted to all customer due diligences that are contained in the AMLD5, but we introduced also already two specific obligations, which are for member states to register these operators and also to submit their senior management to fit and proper test. At the moment the directive was negotiated, I must say that there was no real consensus among the member states. Some of them considered the phenomenon of virtual assets as being too new and wanted to defend the sandbox theory approach, like let a bit the market develop and we will regulate afterwards. Others were very keen in regulating because it's their national culture, the French, for instance. And then some other countries perceived this item as something that we should not legitimate. There were already a lot of rumors, not only rumors, but how would I say, like the darknet and other misuse of virtual assets created some reluctance to give it any legitimacy, and so we could not go much farther than what we already reached in AMLD5, but it was at the time a certain avant-garde, if I can say so, and at the same time the AMLD5 was definitively adopted. The FATF, after having shown a lot of reluctance, started to negotiate also on these items, and it coincided with the US presidency that decided to put virtual assets regulation as one of its top priorities for its presidency of the FATF. Can we move please to the next slide? So the negotiation in the FATF reached we reached an agreement, a consensus, in modifying the recommendation 15 of the FATF, that is normally dealing with new technologies, to introduce an obligation for countries to register and regulate virtual asset service providers. In the same move, we also introduced the definition of what is a virtual asset, and in the glossary of the FATF. So as you can read it on the screen, it is a much broader definition than the one of the Commission. It is less restrictive, and an important point is that it is also mostly a negative definition, because it is when you are not already defined as another item, particularly funds, proceeds, and that you are not already covered elsewhere in the FATF recommendation, that you qualify as a virtual asset. And then for the activities covered, you can read them too. For the activities of the virtual asset service providers covered, sorry, you can also read them. So exchange from virtual to fiat, just like for the EU. Exchange between one and more from virtual asset. This differs from the EU because we do not cover that yet. Transfer of virtual asset. So this one is a bit tricky because transfer of virtual asset as an activity, I mean, you can take it as an activity as such, but many other activities could be considered as including also a transfer of virtual asset. So the question to know whether it is a self-standing activity can be discussed. Then safekeeping and administration of virtual asset or instruments enabling control over virtual assets. We partially cover it already in our framework of the EU through the wallet provisions, but it's broader here. And eventually the participation in and provision of financial services related to an issuer offer and or sale of a virtual asset. And this is very, very broad and goes clearly in much more direction than what we already have in the EU framework. Can we move please to the next slide? Beside of these definitions, I reproduced here the main obligations to which the countries are submitted and that they must introduce in their regulatory framework. So countries must register all VA service providers, and there is some indication about which jurisdiction is responsible. So as a minimum, in the place where the VSP, if it is a legal person, is created, and where the business is located in case we are faced to a natural person. There is also an important detail here, the fact that when you qualify as a financial institution and your national regulation allows you already to deal with virtual assets, you do not need to have a specific license or registration, unless, of course, the countries ask for it. And eventually, and this is the most one of the most difficult part, the travel rule. So it has been introduced an obligation for virtual asset service providers to obtain and hold required and accurate originator and beneficiary information on virtual asset transfers and to make it available on request to appropriate authorities. So it means that at the two ends of the virtual asset transfers, the two virtual asset service providers are supposed to take, among other things, the identity, the beneficial ownership of the person that is using the transfer, both as an originator, and a beneficiary. This creates significant difficulties in terms of technical feasibility. All stakeholders in the industry not being, if I can say, on an equal foot for finding a solution that do. Let's say that many models of virtual asset service providers today did not allow this identification, as raised by the former speaker, and so it remains something difficult for the jurisdiction and the industry to implement. Maybe you can move to the next slide. And this is the reason why the FATF decided to to make a 12-month review of the implementation of the standards when they were adopted in June 2019. So we are now in June 2020, and we're going to adopt at the next FATF plenary a report precisely taking stock of where the industry stands in the implementation of this travel rule. A virtual asset service providers group has been set up with mostly big stakeholders that already presented some technical solutions that seem to fly. So technically, it should be possible to implement this solution, but the problem is how far is inclusive with regard to all stakeholders. And at the moment, this rule is not yet implemented in all jurisdictions. I will get back to it shortly after for the situation at the level of the EU. It is already decided also that we will have a 24-month review, so it means in June 2021, we will see a bit where we stand regarding to peer-to-peer transfers between unhosted wallets, which remains a topic of concern because, as Katja said it before, the problem with peer-to-peer transfers is that it is between individuals and not person acting as a business. So normally it's already excluded from the FATF scope as such. Then the question is how far can we maybe watch the providers of these unhosted wallets or fancy possible solutions to still have an idea of what happens between two individuals using these unhosted wallets. Eventually, the state of play at the FATF at the moment is also that there will be no there is no need for further amendments of the standards at the moment, but we will work on an updated guidance to be released by the first quarter of next year, to give also clearer indication on the standards themselves. Maybe you can move now to the next slide. So now regarding the European Commission, we have taken an important play in negotiating these standards at the level of the FATF, and we are well aware of the need for completing our framework. As mentioned earlier, there is an open consultation that has been launched by the Commission on the new crypto asset initiative already at the end of last year, that gave a first occasion to receive some information about where stakeholders stood regarding the need to broaden the definition of virtual currency, to complete the scope of activities covered by the current AMLD for virtual asset service providers, and also asking whether or not we should introduce the travel rule in the EU framework. The reality is that yes, it is clear that we need to introduce this travel rule, but there is different ways to approach it. We could either go very much into the details at the level of the EU, or on the contrary, just reproduce the FATF standards and giving a lot of room for maneuver for the member states. But in any case, there are still ongoing discussions on this topic at the FATF, and it's a topic that is not yet closed. So getting back to our initiative, so again, the consultation was referring to relating to the crypto asset initiative will give birth to a new initiative that is supposed to be presented in September of this year. And that doesn't deal specifically with money laundering, but it is a possibility to use this legislative vehicle to already address all the issues I already mentioned. The second possibility is that there is a new consultation that has been opened in May, the one that was also referred before, for the next step regarding the update of the Anti Money Laundering Directive. Like after AMLD 5, the next step is normally going to be a single rule book, which means namely a regulation that will cover a lot of different issues normally dealing with CDDs, with obliged entities, and this could be also a possible vehicle to address the different shortcomings that we have now to fulfill in our framework. It has not yet been really decided which of these two initiatives will be the relevant one, but the content is now becoming clearer, and it is true that you can still contribute to the consultation that has been launched in May, and I think you have still mid-July to do so. Maybe we can now move to the last slide, and sorry if I've been a bit long. Just to remind the main items that are already identified. So again, to review the definition of virtual currency to cover all the dimensions covered by the virtual asset definition in the FATF. The activities, but I've already been a bit long on that, so I won't repeat. And among the possible other challenging issues, not yet covered by FATF, but that are maybe not yet totally mature, but on the other hand, things are moving fast, so between now and the moment the proposal will be on the table, let's see where we will stand. But again, peer-to-peer exchange, the issue of anonymity, possible harmonization also of the supervision of virtual asset service providers, and other issues that I didn't quote here could be the ban of mixers and tumblers. But for these ones, I believe that through the exchange platforms between cash and virtual that we already have, member states have already the possibility to ban in reality mixers and tumblers. And eventually, I like just to raise that we might have also to modify our transfer of fund regulation, because the funds under this regulation might not cover in its definition what the virtual assets are. And I will end here, and I'm of course very open to questions if there are any.
Thank you very much, Gabrielle. We do have a lot of very interesting questions coming through, but we've decided to save them for the end, the best part of the webinar. So thank you very much for these insights. It's very interesting to hear about all of these different strands that seem to be moving in parallel. And yeah, hopefully it'll all come together in a regulation at some point. Let's see. But yeah, before we move on to the questions, I'd like to introduce our final presenter today, Dr. Hans Schindler, who's going to discuss and present the key points from the policy paper submitted to this consultation process. Hans, hello again. Yeah, just briefly, I'll mention a couple of points on your biography. Hans, as he said before, is currently Senior Director at the Counter-Extremism Project in New York and Berlin, but he's also a member of the Advisory Board of the Global Diplomatic Initiative in London and of the Board of Directors of Compliance and Capacity Skills International in New York, as well as being an Associated Teaching Fellow at the Academy for Security in the Economy in Essen in Germany. In 2013, he joined the ISIL, Al-Qaeda and Taliban sanctions monitoring team of the United Nations Security Council and served as the team's coordinator from 2015 to 2018. As coordinator, he regularly briefed the members of the Security Council on global terrorism threat and was responsible for the development of global counterterrorism sanctions. Prior to his appointment, he worked as an associate partner for London-based risk consulting firms and as a program director for the Institute for Strategic Dialogue in the UK. Between 2001 and 2011, he held official positions within the federal government of Germany, both in Germany and in the German embassy in Iran, where he focused on security and international terrorism. Following his studies in Tübingen, in Georgetown, and Tel Aviv, he was awarded a master's degree and later a PhD in international terrorism from St. Andrews University in Scotland. And now, Hans, the screen is yours. Looking forward to the presentation.
Thank you very much, Jennifer. I really appreciate it. The idea about this webinar, original from Berlin Risk and us at CEP, was to raise awareness of these ongoing activities. And I think both Kayla's presentation today demonstrating the need for regulation, then also Gabrielle's presentation, talking about all the different initiatives that are going on at this point. He really brought home the point that this is an ongoing, very important process in the European Union. And this is now the time for anyone wanting to help to shape what the framework for crypto assets is going to look like in the future, to step in, because now important things are moving. So let me just start my presentation. So I will be presenting our policy paper in 3 parts. A brief description of what cryptocurrency technology is, and in basic, and where we see Berlin Risk and CEP, the risks for anti-money laundering and CFT, basically a little bit more summarizing what Kayla has done. Then developing regulatory framework. Very briefly, Gabrielle has touched on this in great detail.
Hans, sorry, we can't see your screen yet.
Oh, you can't see my screen yet? I'm so sorry.
Not just yet.
That must be a hiccup. Let me try to do this again. So I'm not sure why that didn't work. Can you see it now?
We can.
Okay, good. I'm so sorry. I don't know what went wrong today. The technique is not my friend. So the 3 parts: description, developing regulatory framework, and then to explain why we come to these particular 4 regulatory recommendations that we make and submitted to the European Union. We suggest to conceptualize crypto asset as a distinct regulatory sector, and I will explain why. We obviously argue for increasing the cooperation between the European Union financial intelligence units and make a suggestion on how this could be possibly done. We do argue very strongly for regulating crypto exchange, and I'll explain very shortly why we think so. And we think that it is, as Gabrielle as well as Kayla have said, there is a need to respond to the challenge of privacy coins and non-custodial wallets or exchanges. And there are several words you could call them: non-custodial wallets or peer-to-peer wallets, or blackboards if you talk about non-custodial exchanges. So just to make sure the terminology, this means essentially the same thing. There are some minor technical differences, but the whole point about these things is peer-to-peer without an intermediary. So let me start with what we see are the risks of cryptocurrencies for anti-money laundering, but specifically, of course, since we are CEP, for counterterrorism financing. We built our policy paper on the year-long study that we did together with Berlin Risk and published in April 2020. You've got here on the slides the link to that report on cryptocurrencies and counterterrorism financing. But we take in both the policy paper and the longer report the view that the technology itself is eclectic. It's neither really good or really bad. It all depends on where the risk profile lies, in particular in our interest for counterterrorism financing. It's not, cryptocurrencies inherently are not something that is particularly built or the idea was to do counterterrorism financing, but it has a specific risk profile. The idea, of course, as most of you I'm sure are aware, is to create a value storage and transfer mechanism that is unconnected and uncontrolled by a central actor like a bank or a government. The political idea behind this was to that any interference by central banks or by governments on money transfers or financial systems brings a political element in it that creates inherently inequality and imbalance within the markets, and that you need to get out from a centrally controlled to a money without the state. So one expert very famously called this that cryptocurrencies are actually an ideology disguised as a technology's network rather than centrally controlled. The 2 key features that we think are, one is very problematic as far as CFT, counterterrorism, combating terrorism financing is concerned, and one is somewhat problematic, is the combination of anonymity and quasi-transparency. So those 2 are absolutely necessary elements in order for this to work as a peer-to-peer network. If you say you make your transactions quasi, and I'll get to this in a minute why we say it's quasi-transparent on the blockchain, you need to have, as a user, anonymity unless you want to broadcast to the entire world what your financial actions are. So the anonymity of the user is necessary because the transparency on the blockchain is there, and the transparency of the blockchain is there in order for the peer-to-peer network to work. If I do not know that my counterpart that I'm dealing with has made successful transactions in the past, I cannot judge whether he's a trustworthy counterpart to me. This technology is fairly new, so it requires a certain level of expertise. And as Kayla has pointed out, that expertise may not be on the security side as well spread even within the industry as it may necessary, but it led to the rise of an intermediary industry, wallet providers, exchanges, over-the-counter trading platforms. And that is where regulation at the moment focuses on, correctly so, because this is exactly the system as it was in the other financial industry that with fiat currency that was already developed. The basic challenge from our point of view, especially for CFT, is the anonymity of the users and the lack of jurisdictional oversight. Of course, there are counter arguments, the transparency on the blockchain and the blockchain analysis, as Kayla pointed out, will give you some indication who may be behind this, but it remains the fact that the identity of the user in counterterrorism financing is a key data point without you can hardly do, because in difference to money laundering, terrorist organizations don't follow particular transaction patterns, the ones that Kayla so very nicely in her graph showed that, because terrorism financing involves much smaller sums. Terrorism financing sometimes, or traditionally, involves not necessarily sums that are generated, or funds that are generated through illegal activities like crime or drug selling, only in very big terrorism organizations or big organizations like the Taliban, that is the case, but smaller terrorist cells usually get donations. So donations are not inherently illegal, but they're then used for legal processes. So you need the identity of the sender or the receiver in order to connect this to terrorism. And of course, since there was a very little regulation until now worldwide, there is not really established compliance processes. So that's on the everything is transparent. And then of course, as Kayla and Gabriel already mentioned, mixers and tumblers and privacy coins really take away the privacy, the transparency argument, because there are technologies that are developed specifically to be intransparent. And then even if all works, your blockchain analysis works, you have a little bit of luck because someone broadcasts their account in a fundraising campaign on a social media account, and you know that all of this is connected to terrorist organization, you can still not lock those or freeze or seize those funds if these funds are not held in a jurisdiction that has regulated cryptocurrencies. So even in the best of cases, everything works, you still run the risk that you can watch terrorism financing, but there is very little you can do against terrorism financing. So regulation is definitely not necessary. Just a very quick overview. Kayla and Tom Keating have published recently a very interesting report on cryptocurrencies and right-wing extremism. I've put here an article, a fairly recent article that also says right-wing groups are interested in. There's of course a long list of incidents where Islamic terrorist groups since 2014 have been shown interest and organized fundraising campaigns. Just to remind everyone who's not with us in the last webinar, the first handbook on how to finance yourself as an ISIL organization was written by an American teenager in 2014. So from the beginning of the Islamic State in Iraq and Syria, its members were interested in this particular asset class. That tells you something. Then we've seen over the years, and there have been known terrorist cases using cryptocurrencies every single year since 2014, things that became actually public. We saw a technical learning curve. So, the very first crowdfunding attempts used regulated exchanges, some even in the US. Obviously quickly they understood that this is not the best way to do this, because you can actually do something in a regulated exchange against terrorism financing. So they moved to unregulated exchanges. Now they published their actual Bitcoin addresses. Now some have begun to use software that allows them to generate a cryptocurrency wallet address every time a user clicks on the fundraising campaign website. So you can no longer really see which one is the actual wallet address where all the money is going to. And of course, we've seen the first attempts of terrorist organizations to use privacy coins, in particular Monero and Dash, to finance their activities. We have, as Gabrielle said, over the last couple of years, some regulatory attempts, both on the level of the FATF and the European Union with AMLD5, to try to get to grips with this problem. The focus is still on the fiat to cryptocurrency node, which is the most logical point to start. They're trying to implement in general the same regulation for intermediaries as they've done for intermediaries of fiat currencies, such as bank or financial transfer organizations. The FATF passed already in 2018 a first guidance showing that there's now a global interest. This was renewed in 2019. It's supposed to be first implementation round until now, June 2020. And most significantly, we think the wire transfer rule that Gabriel already mentioned is a very, very important step. The trigger guidance for KYC, know your customer procedures for intermediaries according to the FATF is €1,000 or US$. This is about the appropriate level for counterterrorism financing, but luckily the regulation also says in suspicious cases, although it doesn't really describe what triggers a suspicion, KYC procedures should be triggered at even lower transactions. With AMLD5, the European Union has done a very important first step in our opinion. This all was transposed into national law until January 2020. Here you see the main points. In particular, as far as Germany is concerned, crypto custody business is now classified as a financial service. This is really important in order to regulate it at all. There's mandatory user identification for those who do fiat to crypto, and you have to monitor all transactions. If you're an obligated entity, in particular those with unusual patterns or no obvious economic or legal purpose. And there's a supervisory authority in Germany, that's the German BaFin. This is, of course, all very good, but now, of course, you need to also gear up the BaFin and the other regulatory authorities in the member states so that they actually have the expertise and technical capability to monitor all of this. There was, of course, an initial resistance by the tech sector. This industry was not built with compliance, AML or CFT regulations in mind. So this was a completely new area from them. But as Gabriel said, there is a growing understanding within the industry. A couple of weeks ago, there was a publication that now there is an agreed standard on how to exchange customer to customer information between exchanges, something akin to a SWIFT technology, to make sure that the travel room where both sides of the transaction have to identify who are their customers, that this is possible. So it is, of course, developing. And sometimes this demonstrates, in my opinion, that regulation actually drives technical innovation rather than stifles technical innovation, which is usually a counter. my apologies. And that's the reason why we do this webinar. We do have public consultations to develop specific EU framework on crypto assets. This leads me to why we're making the recommendations and what recommendations we do. As I said, we argue, please conceptualize crypto assets as a distinct regulatory sector. If you look at the February 2020 ESA, so European Supervisor Authority risk factor guidelines, which is important for the industry as guidelines, but also important for national regulators to see where the risks are, you can see that cryptocurrencies in the 200-page document is only mentioned twice in relationship to retail banks and crowdfunding. Given the current situation, this is the appropriate focus. We've seen crowdfunding by terrorist organizations. We've seen problems that retail banks had in not knowing who their customers are or what their customers otherwise are doing if they held cryptocurrency wallets. However, this is just the current situation. With the adoption of further users using cryptocurrencies, potentially with the rollout of stable coins, in particular Libra, everyone we've spoken to for this paper and for the big report expects that there is an expansion of the user base of other cryptocurrencies as well. Once you get 2 billion users of Facebook used to using some form of cryptocurrency, the likelihood that a significant part of them are going to try to use also other cryptocurrencies is very high. So once you have a bigger user base, you will also have a bigger retail space where you can buy things not having to transfer back into fiat. At the moment, you can already buy a house in Los Angeles. There's a real estate agent that accepts Bitcoin as complete payment for the house. There's a car dealership in Texas where you can buy in Bitcoins for your rare car that you can buy from them. And most interesting, there are several travel offices in Iran that accept Bitcoins as payment to arrange for your hotel and your flight and your guide during this time. So you can see that already with a fairly small user base compared to fiat currencies worldwide, you have retail sectors becoming interested. So if you keep regulating step by step, whatever sector is having an adoption rate, you will always be behind the curve, and regulations usually take longer than the adoption rate in sectors. So several years delay between sector A adopting it, and then the European Union regulating that particular sector and its use of cryptocurrencies is, in the opinion of CEP and Berlin Risk, not a real, rational way to do this. So why not think about this as a sector that you regulate as a crypto asset sector, and then you have already included all the uses by any of the industries. The second is, of course, because cryptocurrencies are built for, trans-border exchanges, quick and easy and with low costs. This can only work, a regulation, if you have an increased cooperation between the different financial intelligence units in the European Union, because regulating this, as I mentioned earlier, requires different resources, different capabilities, expertise, quick and frictionless exchange of information, because you're dealing with real-time transactions here. So a pooling of resources would be budgetary-wise as well as expertise-wise the best way forward, we believe. This could be done, and this is just one of the options, and we've seen already in the European Union the discussion of other options with a similar idea. You could build on the European Banking Authority's EBA already existing mandate to deal with cross-cutting issues, and then within this, develop a European Financial Intelligence Unit dashboard, where you can then exchange information, exchange expertise, host specific blockchain analysis software that may be needed in an investigation here. So pooling of resources at the European Union level, we think is an important point. Otherwise, you have 27 financial intelligence units and regulatory authorities that all have to gear up for the exact same challenge. Third recommendation is regulating crypto-to-crypto exchange. Now, clearly, as Gabriel mentioned, this is something that everyone is talking about. In our opinion, leaving it at the fiat crypto exchange creates an important, but only one level. Once you get past that level as a terrorist, as a money launderer, as a tax evader, for whatever reasons, because you can hide your identity, or the compliance system of that one exchange that you're entering into is not as strong as it should be, or someone makes a mistake, you're free to deal in crypto-to-crypto transactions all you want. And then after many transactions, after you've actually been able to obfuscate where you're coming from, then you go back into the fiat area. So that is not really a good idea, and a single hurdle to overcome is not particularly efficient in our opinion. Therefore, we need to also regulate the crypto-to-crypto exchange, in particular, since we are going down the road slowly and steadily, going down the road to more retail sectors adopting cryptocurrencies as payment. And then if you have the situation that you overcome the first hurdle, and then you buy your weapons, your ammunitions, your chemicals, paying in cryptocurrencies on the market, then we really do have a problem. So a crypto-crypto exchange, in our opinion, is something that needs to be regulated, and we should start discussing this now, because regulation will take time to adopt. Final recommendation, there needs to be a response and a thinking around privacy coins, non-custodial wallets and exchanges. I agree both with Gabrielle and with Kayla that this is not the big crypto market yet. Bitcoin still holds minimum of 60% of all crypto-to-crypto transactions worldwide every day. However, when we talked to specialized traders and technicians for the large report, we were talking about, this is being very difficult. If you are your own wallet provider, you have to understand security. It's not very customer friendly. Is this ever going to take off? And, the technician said, well, that's, it's something that in the medium term, it certainly will. When we then asked, what does medium term mean in the crypto industry? Short term means tomorrow. Medium term, according to them, is 3 years, and long term is 5 years. So, it will get more customer friendly. Therefore, it will get more adoption rate there, because it's simply, you don't have to pay a fee for your own wallet. This is shareware on the internet. So the adoption rate is going to grow over the last couple of years faster than we are going to be able to pass any legislation. And here is where the problem lies. All of the efforts of all of the regulations, be it fiat or currently on the crypto sector, always follow the same pattern. They are built on the foundation of a cooperation between the private sector players and the financial regulators. The first screeners, those who raise suspicions, are the private sector players, because they're the intermediaries, they're the obliged entities, they are bound by the regulation to do so. If these are no longer in play, because now you download a shareware and you create your own wallet, you meet at a blackboard, a non-custodial exchange to do your trades, who is the intermediary who raises the suspicion? Is now every single user its own bank and financial institution and can be obligated to do so? Are we expecting the terrorists to self-identify as terrorist finances? Of course, that's not going to happen. So the only two options that are the nightmare, because it's diametrically opposed to what cryptocurrencies actually are built for, i.e. a centrally monitored market observation by the regulatory authorities, right? So rather than money without the state, that is money that is totally monitored by the state. Or you need to think about, are there any smarter technical tools? And until that time, you try to keep the user base of these technologies as small as possible by simply saying, not in the jurisdiction of the European Union. Then you can look at those within the jurisdiction of the European Union who insist on using these kind of technologies. And you have already a first question that you can ask is, why are you insisting there is a regulated cryptocurrency sector that you can use if you want to use cryptocurrencies? Why do you need to use this specific technology? What is the reason behind that? So you then have already a suspicious area that you can look at, and where law enforcement and intelligence services can pool their resources to look at this customer base, rather than taking a regulatory step back and say, well, it's not yet a large adoption rate here. Why should I regulate this now? So that's in our opinion, for the moment, until there are better and smarter technical solutions than a absolute blanket monitoring, not allowing this technology to be used legally in the European Union is where we would argue. This is concluding my short presentation on our policy paper, and I'm very much looking forward to your questions.